All right, let's dive right into this explainer. Today, we are putting Spotify on the stand and interrogating its 2026 data through the unforgiving lenses of some absolute legendary investors. As an expert investment analyst, my goal today is to cut through all the noise and show you exactly what the math says. We're going to apply the timeless frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and then stress test those against modern discounted cash flow and quantitative models.
We've got 6 distinct frameworks on our agenda today. A quick corporate snapshot, then we'll view the stock through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, followed by some DCF and quantitative models before wrapping it all up with our synthesis and final verdict to see if Spotify's transition to a profitability machine makes it a buy today.
Starting off with Section 1, our Spotify corporate snapshot, looking at their transition from growth to profitability. Right now, as we run this analysis, Spotify, ticker symbol SPOT, is sitting at $485.88 a share. That gives them a massive market cap of roughly $106.6 billion. They've completely morphed from just a pure music streamer into this fully diversified global audio powerhouse. And the reason they're commanding that kind of premium? Well, it's right here in these Q1 2026 numbers. We're talking 761 million monthly active users, and out of those, 293 million are paying premium subscribers. But here's the real kicker. They are posting record operating margins of 15.8% and a trailing 12-month free cash flow of 3.2 billion euros. The revenue engine is absolutely compounding, and they finally got those costs under control. Moving on to Section 2, Warren Buffett's value lens. We're talking moats, management, and margin of safety.
So, if you know Buffett, you know it all starts with the moat, right? Does the business have a protective barrier? Spotify's moat is that towering wall of 761 million global users. It creates this incredibly powerful network effect. Plus, they just bumped up their US premium plan to $12.99 a month. That's their third price hike in 3 years. And get this, there was minimal user churn. That kind of pricing inelasticity, total green flag for the Oracle of Omaha.
Let's actually run through his checklist. Spotify screens incredibly well on quality here. Earnings consistency? Check. We've got 6 profitable quarters in a row. Return on equity? A staggering 38%. The debt is super manageable at just 5.9% debt to equity. And looking at owner earnings, which is a metric Buffett practically lives by, we're seeing 3.2 billion euros in free cash flow. Top it off with co-CEO Gustav Soderstrom making some really smart proprietary AI investments to empower creators, and management looks solid.
But here's the catch. While Buffett would absolutely love the underlying quality and moat of this business, the guy is legendary for his price discipline. His verdict? Fantastic business, questionable price. He would almost certainly sit on his hands and wait for a market pullback to get a true margin of safety below his intrinsic base calculation of $509.
All right, on to Section 3, Peter Lynch's growth lens. It's all about categorizing the story.
Now, Peter Lynch relies heavily on the PEG ratio to make sure he's not overpaying for future growth. You just take the PE ratio and divide it by the earnings growth rate. For Lynch, a PEG of 1.0 is totally fair, and anything below that is a sweet bargain.
Stepping through his framework, first up, we categorize the stock. Spotify is basically graduating from a fast grower into a highly profitable stalwart. The balance sheet is a fortress with 8.8 billion euros in cash. But yikes, look at that PEG ratio. It's sitting at an eye-watering 12.06x. That is highly, highly elevated. To make matters worse, insiders have recently been net sellers to the tune of $40.6 million. Oh, and institutional ownership remains high, which Lynch usually views as a negative since it means the smart money has already crowded the trade. Because of that nosebleed valuation, Lynch's verdict would realistically be a hold or a sell. That 12x PEG ratio simply makes the growth way too expensive for his specific playbook, and that recent insider selling completely cools any remaining conviction. He'd definitely wait for earnings to catch up to the stock price. Next up is Section 4, Benjamin Graham's defensive lens. Consider this the ultimate stress test. So Benjamin Graham is strictly a by-the-numbers guy, and his classic 1930s value checklist literally clashes violently with modern tech. While Spotify easily passes on adequate size and strong finances, it fails spectacularly on everything else. There's no dividend, a very limited history of earning stability, and a trailing PE of 33x that just completely shatters Graham's conservative ceiling. If we run his strict intrinsic value formula, which involves taking the square root of 22.5, multiplying it by earnings per share, and then by book value per share,
and we assume an implied book value of $9.08 based on ROE, the formula spits out a price of just $26.54. Against today's price of around $486, that's a massive negative margin of safety. Graham wouldn't touch this stock today with a 10-foot pole.
Let's fast forward to the 21st century with Section 5, DCF and quantitative models, projecting the future.
Okay, any proper discounted cash flow model needs really clear assumptions. This sensitivity table here shows the weighted average cost of capital, or WACC, against the terminal growth rate. If we assume a pretty standard 10% WACC and a 3.5% terminal growth rate, we land at our base case. But look how drastically Spotify's value swings based on those long-term assumptions. It really proves why you always want to use a range rather than just one single point estimate.
Using AL Capital Advisory's model to project these free cash flows out, we get a bear case of $337, a bull case of $621, and a base fair value of $509. Since the stock is hovering right around $486, we're basically looking at roughly a negative 1% margin of safety against that base case. So, in strict quantitative terms, it is essentially fairly valued right now.
Let's layer in a couple of other models just to be thorough. The ticker target model actually points to a much higher mid case of $745, but that's assuming their ad-supported segment recovers and margins expand into the high teens. Looking at the comparables, the EV to EBITDA multiple is sitting at a pretty lofty 38.4x. Plus, the factor analysis flashes a bit of a warning sign. While it scores a perfect 5 out of 5 on quality, it scores a dismal 2 out of 5 on value. It carries a heavy tail risk downside, which means at these high multiples, your risk is tied entirely to management's ability to execute flawlessly.
Finally, Section 6, Synthesis and Final Verdict. Let's bring it all together. This master scorecard really puts things into perspective, highlighting the massive divide between old-school value and modern growth analysis. Our value purists, Graham and Lynch, are literally screaming sell or avoid because of those sky-high PEG and PE ratios. Buffett totally respects the moat, but he demands a wider margin of safety, making it a hold for him. But then, on the flip side, the modern cash flow models, like the DCF and ticker, are telling us the stock is either fairly valued or actually still has significant upside left.
So blending all these insights together, my final verdict is a solid hold. Look, the business quality is undeniably spectacular. Pumping out 15.8% operating margins and 3.2 billion euros in free cash flow, that proves their transition to profitability is the real deal. And that pricing power is an incredible strength. But the glaring risk is the valuation. At a 33x PE with the high beta of 1.56, this current price leaves absolutely zero room for execution errors. Buying in right now means you are betting on absolute perfection from management going forward.
So, as we wrap up this explainer, you've got to ask yourself a critical question. When you're looking at a highly profitable, deeply entrenched tech giant like Spotify, are you chasing the compounding cash flows of tomorrow, like our modern models do? Or are you demanding the strict margin of safety of today, just like Graham and Buffett? The numbers are all out on the table, but at the end of the day, the final strategy is entirely yours.